Hello everyone, welcome to Betty, our academy. Our job is to make school easier. Kindly subscribe, watch our videos, like, share, comment, and don't forget to hit the notification bell. So in this lesson, we are going to learn about the role of a finance manager. So when you look at what the points that we have here, this one shows the role of a finance manager. 1, producing accurate financial reports and information. 2, developing cash flow statements. 3, projecting profit. 4, managing credit. 5, providing advice in making financial decisions. 6, directing investments. 7, making financial forecasts. 8, budgeting. 9, managing risk of financial loss. Yeah, so we are going to expound on those responsibilities by answering the question, how does finance and the finance manager affect the firm's overall strategy, right? So any company, whether it's a small town bakery or a General Motors, needs money to operate. So to make money, it must first spend money. And how does it spend money? 1, it may spend money on inventory and supplies, equipment and facilities, and employee wages and salaries. Therefore, finance is critical to the success of all companies. It may not be as visible as marketing or production, but management of a firm's finances is just as much a key to the firm's success, right? Yeah. Then there is this other thing that you need to understand. What is financial management? Financial management is the art and science of managing a firm's money so that it can meet its goals. It's not just the responsibility of the finance department. All business decisions have financial consequences. Managers in all departments must work closely with financial personnel. If you are a sales representative, for example, the company's credit and collection policies will affect your ability to make sales, right? The head of the IT department will need to justify any request for new computer systems or employee laptops. Revenues from sales of the firm's products should be the chief source of funding, but money from sales does not always come in when it's needed to pay the bills. Financial managers must track how money is flowing into and out of the firm. They work with the firm's other department managers to determine how available funds will be used and how much money is needed. They then choose the best sources to obtain the required funding. Yeah, because there's also the aspect of cost of finance. For example, a financial manager will track day-to-day operational data such as cash collections and disbursements to ensure that the company has enough cash to meet its obligations. Over a longer time horizon, the manager will thoroughly study whether and when the company should open a new manufacturing facility. The manager will also suggest that the most appropriate way to finance the project, raise the funds, and then monitor the project's implementation and operation. Financial management is closely related to accounting. In most firms, both areas are the responsibility of the maybe the chief finance officer, but the accountant's main function is to collect and present financial data. Financial managers, on the other hand, use financial statements and other information prepared by accountants to make financial decisions. Financial managers focus on cash flows, the inflows and outflows of cash. They plan and monitor the firm's cash flows to ensure that cash is available when needed, right? Yeah, so that's the difference between what accountants do and what financial managers do. So the other thing is about financial managers. They have a complex and challenging job. They analyze financial data prepared by accountants, monitor the firm's financial status, and prepare and implement financial plans. One day, they may be developing a better way to automate cash collections, and the next, they may be analyzing a proposed acquisition. The key activities of the financial manager are Yeah, so when you look at the activities here, we have them here. One is financial planning. Planning here, uh, it involves preparing the financial plan, which projects revenues, expenditures, and financing needs over a given period. Then there's the other activity that they do, which involves investment. Yeah, so that one deals with how do they spend the money, or rather, how do they spend the funds. Investing the firm's funds in projects and securities that provide high returns in relation to their risks. Yeah, so by the end of the day, the farmer, the farm objective is to maximize on the value of the farm. So they will invest the funds in projects and securities that provide high returns in relation to their risks. The other one is about financing. Yeah, how do they raise money? Obtaining funding for the firm's operations and investments and seeking the best balance between debt, right? That is borrowed funds, and equity. Equity, these are funds raised through the sale of ownership in the business. Yeah, so they also need to be very particular when it comes to how do they um, source for funds. Yeah, so the other thing that you need to understand, what are the goals of the financial manager? How can financial managers make wise planning, investment, and financing decisions? The main goal of the financial manager is to maximize, yeah, always they have to maximize the value of the firm to its owners. The value of a publicly owned corporation is measured by the share price of its stock. Yeah, so the way it's trading on the securities exchange, that's how you measure the value of that particular firm. So a private company's value is the price at which it could be sold. That is the market price of a certain firm, of that particular firm, is what will enable us to know the value of a private company. So to maximize the firm's value, the financial manager has to consider both short and long-term consequences of the firm's actions. So at all times, maximizing profits is one approach, but it should not be the only one. Such an approach favors making short-term gains over achieving long-term goals. What if a firm is a highly technical and competitive uh, industry did no research and development? In the short run, profits will be high because research and development is very expensive. But in the long run, the firm might lose its ability to compete because of its lack of new products. Yeah, so I hope you've understood generally what it involves, what are the roles of a finance manager, and what is the how does finance and the finance manager affect the firm's overall strategy. Yeah, and lastly, about the goal of the finance manager. So that's the end of our lesson. Don't forget to subscribe and share our video. Kindly look out for our next video. For now, it's a goodbye.